I learned early that the market does not reward the man who is always busy. It rewards the man who is right, and more often than not, the man who is right is the one who waits. That lesson cost me more money than any bad tip or faulty opinion. You see, most losses don't come from not knowing what to do. They come from doing something when there is nothing to be done. How many times have you felt that itch to be in the market, just because the screen was glowing and the tape was moving? A trader's greatest enemy is impatience dressed up as ambition. I used to think that if I wasn't in the market, I was missing something. But the truth is, the market is always there. It opens every day, and it will open long after you and I are gone. Opportunities are not scarce. Discipline is. The trick is learning to sit on your hands while the crowd mistakes motion for progress. Have you noticed how quiet the market becomes just before it makes its real move? Waiting for setups is not laziness. It is work of the hardest kind. It requires you to study price, to read the behavior of stocks like you would read a man's character. A proper setup announces itself slowly. It doesn't shout. It whispers. Accumulation leaves footprints. Distribution does too. Your job is not to predict but to observe. Can you tell the difference between a stock being active and a stock being ready? Most traders blow their accounts because they treat every fluctuation as an invitation. They trade boredom. They trade hope. And worst of all, they trade fear of missing out. I've done it myself. I chased prices that had already made their move, only to find myself holding the bag when the smart money stepped aside. The market doesn't reward enthusiasm. It rewards patience backed by preparation. If your setup isn't clear, why should your money be at risk? A good setup is like a coiled spring. It takes time to compress. Price tightens, volume dries up, and the weak hands are shaken out. This is not exciting to watch. In fact, it can be downright dull. But dullness is often the market's way of preparing a profitable move. When a stock has done nothing for weeks, have you ever asked yourself who is quietly positioning while everyone else loses interest? Waiting also trains your mind to respect capital. Money is your inventory. You don't throw inventory around just because you're open for business. You deploy it when the odds are in your favor. Every dollar you lose through impatience is a dollar that cannot be used when the real opportunity arrives. The market has a way of presenting its best chances right after you've exhausted yourself on poor ones. Isn't it strange how that always seems to happen? There were periods in my trading life when I made most of my money in a handful of trades. Not dozens, not hundreds. Just a few well-timed commitments where everything lined up. Trend, price action, volume, and market conditions were all in agreement. The rest of the time I waited. I studied. I conserved my strength. Most people cannot accept that kind of rhythm. They want constant action. But trading is not entertainment. It is a business. Would you expect a fisherman to cast his line wildly when the fish aren't biting? Learning to wait changes how you see charts. You stop looking for reasons to enter and start looking for reasons to stay out. You become suspicious of excitement. Big candles after long runs no longer tempt you, they warn you. You begin to understand that the market moves from balance to imbalance, and that your job is to enter when balance has done its work. Have you noticed how the best breakouts often feel uncomfortable because you've waited so long for them? Waiting also builds emotional strength. When you're not overtrading, your mind stays clear. You're not emotionally attached to every tick. Losses, when they come, are smaller and easier to accept because you chose your moment carefully. This calmness is not accidental. It is the result of respecting the process. A trader who waits sleeps better than one who chases. And a rested mind sees more than a frantic one, doesn't it? There's another thing about waiting that most people overlook. It teaches humility. The market does not owe you a trade today or tomorrow. It doesn't care about your goals or your timeline. When you accept that, you stop forcing outcomes. You align yourself with what is happening instead of what you wish would happen. That alignment is where consistency begins. How often have you lost money simply because you wanted to be right, rather than waiting for confirmation? Your setup should be so clear that it feels almost obvious in hindsight. If you find yourself arguing with the chart, You're probably early or wrong. The best trades require the least explanation. They fit your rules, your risk parameters, and the broader market context. When all of that is missing, waiting is not just wise, it is necessary. Why risk capital on uncertainty when clarity eventually arrives? In the end, waiting is not about doing nothing. It is about doing the right thing at the right time. It is about preserving your resources, financial and mental, so that when the market finally shows its hand, you are ready to act without hesitation or fear. Most people never master this because they confuse activity with progress and impatience with courage. And that's the point where the real test begins, because once you truly learn how to wait, the market starts to test how long you can stay disciplined before it finally. Waiting is a trading decision, not a lack of one, and that idea took me longer to learn than any chart pattern or rule of speculation. Most people believe that trading is about action, about being involved, about pressing the button. They think that if they are not buying or selling, they are failing to do their job. But the market does not see it that way. The market only recognizes one thing: whether your decision aligns with the truth of price. Sometimes the correct decision is to act, and sometimes the correct decision is to stand aside. Can you see how those two are equally important? When you choose not to trade, you are not avoiding responsibility. You are exercising judgment. You are saying that the conditions are not right, that price has not earned your money yet. That is a deliberate act of discipline. It takes more control to do nothing than it does to do something, especially when the tape is active and your emotions are whispering that you're missing out. How often have you entered a trade simply because you felt you should be doing something? The market is open most days, but opportunity is not. Opportunity arrives only when preparation meets alignment. Price must be in the right place, volume must confirm the story, and the broader market must not be working against you. When those pieces are missing, waiting is not hesitation, it is intelligence. You are preserving capital and mental clarity. You are protecting yourself from unnecessary exposure. Isn't it interesting how many traders confuse patience with fear, when in reality impatience is the more dangerous emotion? A trader who understands waiting begins to see inactivity as part of the strategy. He stops measuring his success by how many trades he takes and starts measuring it by how well he follows his rules. He knows that every trade carries risk, and that risk should only be accepted when the odds justify it. By waiting, he is filtering out low-quality opportunities. He is allowing the market to come to him rather than chasing price across the screen. Have you ever noticed how price often moves best when you least expect it? Waiting also changes your relationship with money. When you accept that not trading is a valid choice, you stop feeling pressure to make something happen. Your capital becomes a tool, not an obligation. You don't feel the need to deploy it just because it's available. This mindset alone can save a trader from countless mistakes. Money that is not lost is money that can be used later, when conditions improve. Isn't preservation the first step toward long-term success? There were times when my greatest gains came after long periods of inactivity. Not because I was lucky, but because I was rested, focused, and ready. I had not drained myself emotionally or financially by forcing trades. Waiting kept my judgment sharp. It allowed me to recognize opportunity instantly when it appeared. A trader who is always in the market is often the slowest to react when the real move begins. Do you see how overtrading dulls perception? Most people fear waiting because it exposes them to their own thoughts. Silence makes them uncomfortable. They want constant feedback, constant validation. But trading does not reward those needs. The market does not care how you feel about waiting. It only cares whether your timing is correct. Learning to sit through quiet periods builds emotional resilience. You stop depending on the market for excitement and start treating it like a professional environment. How can you expect consistent results if your decisions are driven by discomfort? When you choose to wait, you are also choosing to trust your preparation. You are saying that your rules matter more than your impulses. That is a powerful shift. It means you are no longer reacting to every fluctuation. You are responding only when the market meets your criteria. This is how consistency is formed. not through constant action, but through selective action. Do you really believe that every price movement deserves your attention? Waiting teaches you that missed trades are not losses. They are simply trades you were not meant to take. This understanding removes regret from your process. You stop looking backward and start staying present. The market will offer another opportunity. It always does, but only if you still have the capital and confidence to take it. How many traders are sidelined not by bad markets, but by their own inability to wait? A lack of waiting often shows up as emotional trading. Entering too early, exiting too late, adding to losing positions, all stem from the same root problem: the refusal to accept inactivity. When you redefine waiting as a decision, these behaviors lose their power. You no longer feel compelled to interfere. You let price confirm your ideas instead of forcing them. Isn't confirmation worth the time it takes? Waiting also aligns you with the rhythm of the market. Markets move in phases: accumulation, expansion, distribution, and decline. Only one of those phases offers favorable entry. The others demand patience. By waiting, you synchronize yourself with that rhythm instead of fighting it. You stop trying to extract money from random movement. You wait for structure, for clarity, for imbalance to reveal itself. And in those moments, action becomes simple, almost effortless, because the decision has already been made through patience, through observation, through restraint, through the quiet discipline of waiting while others rush ahead without knowing why they are there at all. A real setup feels quiet before it feels profitable, and that silence is what most traders can't tolerate. They mistake noise for opportunity and movement for meaning. I've watched markets long enough to know that when everyone is talking, when prices are jumping around and excitement fills the room, the best part of the move is usually already behind us. The real money is made earlier, when nothing seems to be happening at all. Have you ever noticed how the market grows calm right before it surprises everyone? That quiet phase is where preparation shows itself. Price stops racing and starts compressing. Volume thins out, not because interest is gone, but because weak hands have been shaken loose. This is the stage where professionals pay attention and amateurs lose patience. Nothing dramatic happens, and that's exactly why it works. The market is gathering itself. It's deciding its next direction. If you need constant stimulation to stay engaged, this phase will feel unbearable, won't it? Most traders are conditioned to believe that profit should feel exciting from the start. They expect fireworks the moment they enter. But real setups don't announce themselves with drama. They form slowly, quietly, almost politely. You can miss them easily if you're distracted or impatient. The chart looks dull. Candles overlap. Price goes nowhere. Yet beneath that surface, pressure is building. Doesn't it make sense that the strongest moves would come from the tightest conditions? Quiet setups demand observation instead of prediction. You are not guessing where price will go, you are watching how it behaves. Is it holding key levels? Is it refusing to break down despite bad news? Is volume drying up instead of expanding against the trend? These small details only stand out when the market is calm. In noisy conditions, everything looks important. In quiet conditions, only the truth remains. How often do traders ignore this because they want action now? Silence in the market also tests confidence. When price doesn't move, doubt creeps in. You start questioning your analysis, your rules, your patience. That's when many traders sabotage themselves by entering too early or abandoning the idea entirely. They want reassurance, and the market offers none. A real setup doesn't comfort you. It challenges you to trust your process. Can you stay committed without immediate reward? There's a reason institutions build positions during quiet periods. They cannot buy all at once without pushing price against themselves. They need time. They need calm. So they operate when the crowd is bored. By the time excitement returns, their work is already done. The breakout everyone sees is not the beginning, it is the result. If you wait for excitement, you're late. Isn't it strange that most traders want to enter only after risk has increased? Quiet setups also protect you from emotional mistakes. When nothing is happening, there's no rush. You can plan entries, define risk, and think clearly. You're not reacting to sudden spikes or fast drops. Your decisions come from logic, not adrenaline. This is where discipline becomes visible. Anyone can click buttons when the market is moving fast. Few can sit still when it isn't. Which one do you think survives longer? A trader who understands quiet setups stops forcing trades. He accepts that inactivity is part of the business. He studies charts without expectation. He waits for alignment. And when the market finally moves, he's not surprised. He's prepared. The move feels natural, almost obvious, because it grew out of that quiet structure. Have you ever entered a trade that felt calm instead of exciting, and noticed how differently you managed it? Noise hides risk. Quiet reveals it. When price is calm, you can see where you're wrong. Support and resistance are clear. Invalidation levels make sense. You know exactly where you shouldn't be in the trade. That clarity disappears when volatility explodes. Then decisions become emotional, exits are rushed, and losses grow larger than planned. Wouldn't you rather enter when risk is defined instead of when emotions are high? The market spends more time being quiet than it does being explosive. This is a fact many traders ignore. They focus on the highlight moments and forget the long stretches of preparation that made those moments possible. If you can't learn to operate during quiet periods, you are only trading a small fraction of what the market offers. Isn't it limiting to depend only on excitement? Quiet setups also build patience, and patience builds consistency. When you learn to wait through dull phases, you stop needing constant wins to feel competent. You stop tying your self-worth to daily results. You begin to think in probabilities and sequences instead of single outcomes. This mindset keeps you steady when trades don't work and focused when they do. Can you see how emotional balance starts long before the trade itself? Many traders misread quiet as weakness. They think a stock that isn't moving must be broken or uninteresting. In reality, it may be doing its most important work. It is absorbing supply. It is rejecting lower prices. It is preparing for expansion. But preparation doesn't look impressive. It looks boring. That's why it works. The crowd leaves and the stage clears. Do you really want to trade where everyone else is watching? When you begin to appreciate quiet setups, your whole approach changes. You stop scanning for excitement and start scanning for structure. You become selective. Fewer trades, better trades. Less stress, clearer thinking. You no longer feel the need to predict the market's next move. You let it reveal itself in its own time, through its silence, through its restraint, through that subtle tightening of price that tells a careful observer that something is coming, even though nothing seems to be happening yet. Constant action usually signals emotional trading, and that truth is uncomfortable because it forces a trader to look inward instead of blaming the market. I've seen it countless times, in others and in myself. The trader who is always clicking, always adjusting, always in a position, believes he is being productive. He feels engaged, involved, alive. But the market does not reward activity. It rewards clarity. And excessive activity is often nothing more than emotion looking for an excuse to express itself. Have you ever noticed how the urge to trade grows strongest when nothing fits your plan? Emotional trading rarely announces itself honestly. It disguises itself as analysis, as discipline, as opportunity. A trader tells himself he is staying sharp, or scaling in, or testing the waters, when in reality he is uncomfortable with waiting. The screen becomes a trigger. Every tick feels important. Every candle feels like a message meant just for him. But markets move whether you are involved or not, and most of those movements have nothing to do with opportunity. Isn't it curious how action feels urgent even when logic says it isn't necessary? Constant action usually comes from a need to control outcomes. The trader wants to feel in charge, to feel like he's steering the ship. But the market does not hand over control so easily. When price moves against him, he reacts. When price moves slightly in his favor, he meddles. Entries become rushed, exits become delayed, and decisions stack on top of one another until the original plan is buried under impulse. At that point, trading is no longer strategic. It is reactive. Can you really call that decision-making? There is also fear beneath constant action. Fear of missing out. Fear of being wrong. Fear of being left behind while others profit. These fears push traders into the market when conditions are unclear. They trade not because the setup is strong, but because they want relief from uncertainty. Taking a trade feels like doing something about the fear, even if it increases risk. Isn't it ironic that the attempt to escape discomfort often creates larger losses? Emotional trading feeds on momentum, not market momentum, but emotional momentum. One impulsive trade leads to another. A small loss creates urgency. A small win creates overconfidence. Suddenly the trader is no longer following the market. He is chasing his own emotional state. The chart becomes secondary. The account balance becomes a scoreboard. This is where constant action becomes dangerous, because the trader is no longer trading price, he is trading himself. How can consistency survive in that environment? A disciplined trader understands that restraint is an active skill. Not trading is not passive. It requires awareness, intention, and control. When you step back instead of acting, you interrupt emotional momentum. You give logic time to catch up. You create space between impulse and decision. That space is where good trading lives. Without it, every emotion flows directly into the market through your account. Have you ever paused long enough to notice how quickly emotions fade when you don't act on them? Constant action also erodes your ability to read charts objectively. When you are always in a position, you start seeing what you want to see. Support becomes stronger than it is. Resistance becomes weaker than it should be. You reinterpret information to justify staying involved. This is not analysis, it is attachment. And attachment clouds judgment. A trader who is flat, who is waiting, sees the market more clearly than one who is emotionally invested in every move. Doesn't clarity matter more than involvement? Another cost of constant action is fatigue. Trading demands mental energy. Every decision, even a small one, consumes focus. When you are constantly acting, your decision-making quality declines. You become sloppy, you miss details. You rush through analysis. Emotional trading thrives in tired minds. That's why overtrading often leads to the worst mistakes at the end of the day, not the beginning. Would you expect good judgment from exhaustion in any other profession? Markets offer limited high-quality opportunities. They do not need constant participation. When a trader treats every moment as tradable, he lowers his standards. Setups that would have been rejected on a calm day suddenly look acceptable. Risk, reward becomes an afterthought. The goal shifts from executing well to simply being involved. This is where emotional trading becomes habitual. Action becomes the default response, not the considered one. How many losses come not from bad setups, but from lowered standards? Constant action can also mask insecurity. A trader who doubts his edge often trades more, not less. He looks for confirmation through frequency instead of accuracy. He believes more trades will lead to more confidence, when the opposite is usually true. Confidence comes from following rules and seeing them work over time. Emotional trading interrupts that process. It replaces learning with noise. Can confidence really grow when every trade ignores the plan? Learning to reduce action is one of the hardest transitions a trader makes. It feels like stepping away from responsibility. It feels uncomfortable, especially in a culture that celebrates hustle and constant engagement. But trading is not about proving effort. The market does not grade participation. It only reflects results. A trader who learns to be selective begins to regain control over his emotions. He trades less, but with more intention. He accepts that doing nothing is sometimes the most professional response. When constant action fades, awareness increases. You start noticing patterns in your own behavior. You see when impatience rises, when boredom pushes you, when fear whispers excuses. This self-awareness is what separates emotional trading from deliberate trading. The market hasn't changed. You have. And that change doesn't come from more action, but from less, from restraint, from learning to sit with uncertainty without needing to resolve it immediately, from recognizing that the urge to trade is not the same as a reason to trade, and that every moment you resist unnecessary action, you strengthen the discipline that will matter when the market finally offers a situation where action is justified and required and aligned with price instead of emo habit and a restless need to always be doing something instead of waiting for the moment. when doing something eventually makes sense. Discipline is built in the pauses between trades, not in the moments when you are clicking buttons and watching candles move. Most people think discipline shows up when you enter or exit, when you manage risk or take profit. But those are the visible moments. The real work happens when nothing is happening, when the market is open and you decide not to participate. That pause is where habits are formed. That pause is where discipline either grows stronger or quietly collapses. Have you ever noticed how easy it is to follow rules when you're already in a good trade, and how difficult it is when you're waiting for one? The space between trades exposes your true relationship with the market. When you are not involved, there is no distraction. You are left with your thoughts, your expectations, and your patience. This is uncomfortable for most traders. They feel unproductive. They feel behind. They feel like opportunity is slipping through their fingers. But discipline does not come from constant engagement. It comes from restraint. It comes from the ability to remain calm and selective, while the market does what it always does, move without regard for your feelings. Can you sit through uncertainty without trying to resolve it with action? Every pause is a test. The market is always offering movement, but not always offering opportunity. Discipline is the ability to tell the difference. When you pass on a mediocre setup, you are strengthening your standards. When you wait for confirmation instead of anticipation, you are reinforcing patience. These decisions may not feel rewarding in the moment, but they compound over time. Just like bad habits compound losses, good habits compound clarity. Do you recognize that every trade you don't take is shaping the trader you are becoming? The pauses between trades are also where emotional awareness develops. When you are active, emotions are tied to price. When you are inactive, emotions have nowhere to hide. Boredom, impatience, doubt, and fear rise to the surface. Many traders try to escape these feelings by trading more, but that only buries the problem. Discipline is not about suppressing emotion. It is about observing it without obeying it. When you can feel the urge to trade and still choose not to act, you are building control. How often do you mistake emotional discomfort for a signal? In those quiet moments, you begin to see patterns in yourself. You notice when boredom pushes you to lower your standards. You notice when a recent loss creates urgency. You notice when a recent win makes you overconfident. These insights don't come during fast markets. They come during pauses. And once you see them, you can address them. Discipline grows from awareness, and awareness requires stillness. Isn't it interesting that the market teaches discipline by doing nothing? Pauses also reinforce respect for capital. When you are not trading, your money is safe. It is intact. It is ready. This reinforces the idea that capital is valuable and should not be exposed casually. Traders who never pause often treat money like fuel to be burned rather than inventory to be protected. Discipline means accepting that preservation is part of the job. It means understanding that not losing is just as important as winning. Can you value protection as much as profit? The longer you trade, the more you realize that most mistakes happen between good setups, not during them. They happen when impatience fills the gap. They happen when the trader feels the need to force continuity, to turn trading into a constant stream instead of a selective process. The pause interrupts that pattern. It resets expectations. It reminds you that trading is episodic, not continuous. Opportunities come in waves, not on demand. Are you willing to let the waves form before trying to ride them? Discipline in the pauses also sharpens your edge. When you are selective, your best setups stand out clearly. You are not comparing them to dozens of marginal trades. You are comparing them to nothing. This contrast makes quality obvious. It also makes execution easier. When you finally act, there is less hesitation, less second guessing. The pause has done its job. It has filtered noise from signal. It has prepared you mentally. Do you notice how decisive you feel when you've waited properly? There is also a confidence that comes from disciplined waiting. Not the loud confidence of constant action, but a quiet confidence rooted in trust. Trust in your rules. Trust in your preparation. Trust that the market will offer another chance. This confidence does not depend on recent results. It depends on consistency of behavior. And that consistency is built trade by trade and pause by pause. Can confidence really grow if you never give yourself time to reflect? The market does not punish you for waiting. It punishes you for forcing. Many traders learn this lesson repeatedly, but never fully accept it. They continue to believe that discipline is something you apply only when things are moving fast. In reality, discipline is a slow skill. It grows in silence. It grows when you review charts without trading them. It grows when you watch price reach your level and still wait for confirmation. It grows when you close the platform instead of inventing a trade. How often do you practice discipline when no one is watching? Over time, these pauses change how you see the market. You stop feeling rushed. You stop feeling obligated. You stop measuring your days by trades taken and start measuring them by rules followed. This shift reduces stress and increases consistency. The market becomes less personal. Losses hurt less because they are fewer and better planned. Wins feel earned rather than lucky.